Welcome back, XRP community. Today we're going to unpack a series of economic and regulatory moves that are quietly reshaping the future of cryptocurrencies and, more importantly, the structure of the global financial system. None of this is rumor. These are public statements, policy decisions, and corporate strategies that will define the environment XRP has to operate in over the next few years. On the surface, the crypto market looks calm. Bitcoin hovering in the 90,000 range. XRP trading a little above $2. Most majors consolidating after weeks of volatility. But underneath that calm, central banks are changing direction and regulators are opening new doors. In less than 3 days, the Federal Reserve is expected to cut rates again. Quantitative tightening is effectively over. A new phase of quantitative easing, liquidity injection instead of liquidity drain, is beginning. That's the macro backdrop. Now, let's layer in politics and capital flows. President Trump has spoken openly about a potential wave of up to $20 trillion in new capital moving toward the United States. That number is not about printing money out of thin air, and it is not about brand new taxes. It refers primarily to repatriation of capital, tax incentives for corporations, and policies designed to pull foreign funds, sovereign wealth, and institutional liquidity onto U.S. soil. If even a fraction of that figure materializes, it means one thing above all: a massive increase in available liquidity inside the U.S. financial system. Historically, that kind of inflow supports financial markets, boosts investment in technology, and increases risk appetite. It does not guarantee anything for crypto, but it creates a much more favorable environment for regulated, utility-focused digital assets to attract institutional attention. On the regulatory side, we have a signal that deserves a lot more attention than it is getting. The CFTC's acting chair, Caroline Pham, has announced a major step: the approval framework for spot crypto trading on federally regulated exchanges. That sounds technical, but the implications are big. Regulated spot trading means clearer legal protection for investors and firms. It lowers operational risk for institutions that want exposure to digital assets but have strict compliance requirements. It creates a cleaner on-ramp for ETFs and other structured products because they can reference markets that live under federal oversight instead of offshore or loosely supervised venues. In other words, it is a piece of the plumbing that large capital has been waiting for. This move is not about one specific coin. It is about building the legal rail that allows the sector to grow with rules instead of enforcement by surprise. The missing piece is still the Clarity Act, the broader regulatory framework for digital assets in the U.S. Initially, many expected it to pass by the end of this year. Realistically, it now looks more likely for 2026. But the direction is set, from regulatory hostility to regulatory integration. While the U.S. sorts out its legal architecture, Europe has started speaking more openly about specific technologies. A notable example: French financial giant BPC has highlighted XRP as the fastest token in its class. This is not a price prediction, not an investment recommendation, but a technical recognition. They pointed to settlement times around 3 seconds on average, extremely low transaction costs, and suitability for cross-border payments and remittances. What this tells you is that European institutions are actively evaluating blockchain solutions for payments. And not every chain qualifies. In the payments world, speed, cost, compliance, and ISO 20022 compatibility matter. XRP ticks those boxes. Now we arrive at the headline: Ripple's plan to retain up to 25% of the entire XRP supply. According to reporting from Fortune, Ripple has outlined a strategy to hold as much as 25% of the total 100 billion XRP supply. That's roughly 25 billion XRP. Not circulated, not dumped on the market, but strategically retained. How should we interpret that? First, as a corporate strategy, Ripple is signaling that it wants to maintain a strategic reserve for future use cases. If XRP is going to be the backbone for institutional payment corridors, tokenization platforms, collateral frameworks, and liquidity hubs, Ripple cannot afford to be completely empty-handed in a world where exchange balances gradually shrink. Keeping a quarter of the total supply available under corporate control means they can support on-demand liquidity, provide collateral to institutional partners, and stabilize key projects as adoption grows. Think about initiatives like institutional lending platforms, collateralized products, and specialized entities designed to offer XRP as high-grade collateral. Those structures need reliable access to tokens. A company that believes demand will grow does not sell everything. It reserves inventory for future strategic deals. Second, we need to separate this decision from the FIT21 discussion. FIT21 is a draft legal framework that sets rules for digital asset governance, custody, and issuer behavior. One of the talking points around FIT21 has been the idea of limiting how much of a token an issuer can effectively control. Numbers around 20% get quoted frequently. But FIT21 does not set token prices. It does not tell Ripple what a fair market cap is. It defines compliance obligations, reporting standards, and how custodial and governance structures should be organized. Ripple's decision to aim for retaining up to 25% is a corporate move that will ultimately have to align with whatever the final FIT21 and related regulations require. The key point is that these are two separate layers. One is a legislative framework about governance and custody. The other is a business strategy about inventory and long-term liquidity. There's also a signaling effect here. A company that plans to hold a large share of supply is not acting like a player preparing to exit. It is acting like an infrastructure provider positioning itself as a long-term, regulated backbone for payment and settlement flows. If Ripple intends to become a fully licensed digital bank in the coming years, as many rumors and strategic moves suggest, then holding a meaningful reserve of the native asset that powers its rails makes sense. Consider the broader context. Every month, Ripple releases XRP from escrow, sells a portion into the market, and relocks the rest. Historically, that alarmed some investors who viewed it as constant sell pressure. A shift toward retaining a fixed strategic slice of the total supply flips that narrative. Instead of maximizing short-term sales, the company is prioritizing long-term control and capacity. Now, layer on top what is happening with central banks and gold. China has been buying gold for 13 consecutive months. In November 2025 alone, it added around 30,000 ounces, raising its official holdings to over 74 million ounces. That is not a casual purchase. It is a long, deliberate accumulation trend. Why does that matter for crypto and XRP? Because it reveals how major states are thinking about risk and reserves. Gold accumulation at this scale usually signals three things: diversification away from dollar-only exposure, preparation for potential recession or financial instability, and concern about future monetary policy and inflation. Pair that with geopolitical tension, U.S. Venezuela, China, Japan, Middle East flashpoints, the ongoing Russia-Ukraine conflict, and you see a map of central banks quietly getting more defensive, even as they talk publicly about stability. The combination we are seeing now is unusual. Rising geopolitical tension, a pivot from tightening to easing in monetary policy, structural regulatory progress for crypto, and explicit institutional recognition of XRP's technical strengths. At the same time, Ripple is moving to secure a significant portion of XRP's total supply as a strategic asset, not a short-term revenue source. None of this guarantees a straight line up for price. Markets can stay irrational longer than most investors can stay calm. But it does tell you that the environment around XRP is changing. Capital is preparing to move. Regulators are preparing to integrate. Banks and institutions are preparing to use blockchain not as a toy, but as infrastructure. If you want a second deep dive on this topic, specifically on how Ripple's 25% retention strategy could interact with future ETF growth, bank licenses, and collateral frameworks, drop a comment saying Part 2, and we'll prioritize it. And if you want to keep following the macro, the regulation, and the XRP story day by day, make sure you like this video, subscribe, and turn on notifications. We're just getting started.